Well, welcome everyone. It's Thursday night and we're going to be talking about money, but tonight our topic is more about borrowing and how much is too much. We're definitely excited for you to be a part of week number 2. Can't believe it. So we're going to start with introductions. So tonight I'm Sasha Grobinstetter. I reside in Grundy, Kankakee, and Will counties. That's kind of where I teach at with the University of Illinois Extension. And then I'm going to let Kathy introduce herself.
Hi, I'm Kathy Sweedler, and I'm also a consumer economics educator. I work out of the Champaign, Ford, Iroquois, and Vermilion counties, but enjoy getting to teach around the state as well.
Thank you, Kathy. Kamaya is out of the office this week, so you won't be seeing her, but we definitely miss her, and she'll be back next week. So if you don't mind hopping on the chat, I know a lot of you have already found it, but if you could put in the chat what city you're logging in from today. I would really appreciate it. Champaign, Urbana, Orlando, Florida, heck yeah, Durant, Oklahoma, Bloomington, Portsmouth, Ohio, Morris, Illinois, Denver, Savoy, lots of Ohio's tonight, Bourbonnais, New Jersey. This is great. So make sure that you find that chat. Love to see everyone, get involved tonight. So that's why we do one of these quick polling questions. So as we get started tonight, we're going to be talking a lot about borrowing. So these kind of are our learning objectives for this week. We're going to be able to list a variety of lenders. We're going to talk about weighing the cost of credit against the advantages. We're going to be talking about the different types of high cost lending. We're also going to compare the pros and cons of different types of lenders. But we're also going to talk about annual percentage rates as well. And so I'm looking forward to talking about all these things tonight. So since you've already found the chat with telling us what city you are, we want to talk about how do people borrow money? If you didn't find that chat earlier, definitely find it now because we'd love to hear from you guys. But I just want to know how do people borrow money? And it can be anything. So just think any kind of grandparents, banks, taking out loans, home mortgage, woo, friends, financial institution, parents, credit cards, title loan on a car, payday loans, banks, family members. These are all great. IOUs, that's one as well. Guido the loan shark. I like it. I like the loan. That's very funny. Financing, equity loans. Great. These are great, everybody. We really appreciate you getting involved with the chat. So we are going to do some polls. So last week we used the chat feature a lot and we used the breakout rooms a lot. And that was for the first time ever we've done that. So tonight we're going to try some polling questions and they're completely anonymous. So we just want everyone to know that. So I'm going to switch over to this. So when the chat comes up, your options are yes, no, or only if. And if you'd like to, you feel like you need to kind of justify your only if, you can share that in the chat if you'd like. It's really up to you. But Kathy, if you wouldn't mind watching those polls. Great. And if you guys don't mind, these are, again, completely anonymous. So just, the first one is, would you borrow money if you're of a new refrigerator if yours broke? So I love seeing them come in live. Makes me really excited. We're gonna get close to that 78 of all the participants.
So are people seeing all 5 questions at one time? I just realized that's a
just
question
one. I just see the first one.
Okay.
I just see the first one. Yep.
From my view, it's a little more limiting to see.
A little more technical over there.
Good, thanks, Jean.
So great. We're getting really close to that 100%. Kathy, if you wouldn't mind, in about 5 seconds, we're going to close it up. Just want to see what everyone says. Great. So the polling's closed. So a majority of you said no. You wouldn't borrow money to buy a new refrigerator if yours broke. 27% said yes. And some people said only if. So I'm going to check the chat. One person said, I cook a lot and I don't want to get sick. Totally understand that. So great. Great. These are great. Kathy, would you launch the second poll?
What I was going to ask you is, would you get a loan to buy a car? And just, I know it says something else on the screen, but maybe you can reply to that. Would you get a loan to buy a car?
Oh, the answers are changing. I think there's a lot more chat going on. Let's see what the chat says. Chat says yes. I'm actually thinking about doing that. Any advice would be super helpful. Question somebody asked, is it a want or a need? Also, somebody said it depends on your income. Great.
Okay. Oops. All right. That was a very different answer that people had. And lot more people said yes, they'd consider it for that.
Yes.
Okay, let's try it again. Would you borrow money from a relative or a friend to go on a cruise? Would you borrow money from a relative or a friend to go on a cruise?
Again, there's no right or wrong answers here. We just want to know, would you or wouldn't you?
This is just a way of kind of exploring how people have different attitudes about, about credit, right?
Mm-hmm.
So that, I don't know, you guys don't like to take cruises? So, no.
Borrow the money from the family for the cruise.
All right, so that was a clear no in most cases, which I think is very interesting. So, I might be inclined, but anyway. Okay, let's try. How about this one? Would you use credit even if you could pay cash? Or whatever, like just you're out and about. Would you use credit even if you could pay cash?
Oh, these are spread. I like watching the answers come in. So to answer this question, Kathy, I would, because I get lots of rewards from my credit cards. And so I would, if I had the cash, I would just use credit.
Yeah, and there's a level of convenience. I don't know what people are putting in the chat because I can't see that at the moment, but I think that, may be part of the, using credit to pay.
Some people, one said I do travel hacking. Yes, for small amounts, that they pay their credit card off monthly. It's for the perks. So, and then the last polling question, if Kathy, you don't mind, is would you use a credit card to pay for big name concert tickets? So whatever you're like, well, it doesn't have to be dream, but just a big name that you enjoy. Would you use credit to pay for concert tickets?
Sometimes those kind of come into town. You didn't know they were coming.
Mm-hmm. Not that we're going to concerts right now, but in the future.
Depends on who it is. I love it. Some people say they pay off their credit card monthly. So opposed to cash or debit. Yeah, that's one way to think about it.
Those are great answers.
Sometimes it's a lot easier to buy those kind of tickets with a credit card. Usually
I'm the one buying all the tickets. So then people have to pay me back.
All right. Well, thank you everybody that participated in putting up with the fact that the polling questions didn't work quite the way I expected. We still got a chance to have some interaction here, so that was good.
That was really great. Yeah, thank you, everybody. Okay. So, again, there's no right or wrong answers here. It was just kind of us seeing kind of the differences with borrowing. And then I just want to know in the chat, if you guys don't mind answering, how do you decide when it's worth it to use credit? How do you decide when it's worth it to use credit?
You might want to change your slide too.
Oh, it went to this next slide, which is.
So we've got if it's convenient, depending on need, rewards are definitely a factor. Somebody said they charge everything and pay it at the end of the month.
Big buys. High cost item in need. Oh, these are going fast now.
Yeah. If I can pay it off. Interest rate. Yeah. It's worth it to think about it because sometimes there are good, very good reasons to use credit, and sometimes, people have good reasons to hesitate too. So So, it's worth kind of thinking about what is best for you. And now what I've also found is that for some people, it works. They can use their credit card and pay it off at the end, no problem. And for other people, that might be more troublesome. So purchasing over the internet, that's a really good point. We actually get more protections because of the way federal legislation is when we use a credit card to buy something over the internet or through a catalog than we do when we use our debit cards. We're able to stop payment. People don't already have our money, so they're more willing to listen to complaints we might have. And so it's also safer than a debit card.
Kathy, can you see the annual percentage rate
We
slide?
see it.
Okay, well, it's your turn, so I'm gonna let you talk for a little bit.
Okay, so what we just wanted to talk about a little bit here is annual percentage rate and discuss how that knowing what the APR, annual percentage rate is, can help us when we're making financial decisions. And so the nice thing about an APR is that it allows us to compare apples to apples. So sometimes might be looking at different loan options that maybe one is for X number of months, another one's for more months. And if we're just looking at interest rates or we're just looking at different ways of calculating things, it used to be really hard for people to compare. But now with an APR, we can look at it because it looks at what is the rate that you're going to pay over a year. And we want to make sure that we're looking for lower annual percentage rates, lower APRs, because the higher the APR, the more you're going to pay back in interest over time. And while I think we all have sort of a general feel for APR probably, I think it's also good to review, how much does it vary from one type of loan to another? And you guys had a fantastic list of places that people can borrow money from, and I'm going to take a look at that, and we're going to talk a little bit about the expected interest rates or APRs for each of these. So this is just kind of a little kind of some of the general ones that tend to come up, and I think I did see most of these in that list. And one of the places that people can borrow money from is family and friends. And before we give the answers, hold on there, girl. But that's okay. So that one, a lot of times people tell me when I'm live that usually when they borrow money from family or friends, there's 0% APR. That may not be true. In my family, if we borrow money from somebody to start a business or buy a house, usually there is an interest charge there, but different families, different things. All right, so then my question for you is, how much do you think an APR is running right now for credit cards? Maybe you can put that in the chat, what you think that APR is right now. And I'm seeing 20%, 16%, excellent. 19.8, up less than 30%. So I had just put down, you guys are all right on target, somewhere between 16 to 25%, although I have seen 30%, I've seen 39% before. So quite a bit of variation there. We talked about in the chat about borrowing money from banks and credit unions, and that is another place that you can go and get a personal loan, and they vary a lot. Of course, all these do based on somebody's credit history as well as the current market situation. But I think we could say a personal loan tends to vary between 15 to 30%. And this could vary quite a bit depending on an individual situation. Looking at the home mortgage industry right now, which actually I've been looking at pretty closely, we're seeing some very low rates for the kind of historically. And does anybody know what the rates are right now? Has anybody seen 3%? That's right on target. 3-ish, yeah. Again, it's going to vary by financial institution, by location, and it moves around each week. But right now, we're right around 3.25% on average. So yeah, you might find something lower. This is the 30 years that I was looking at. Okay, car loans, another big variation, but I just think somewhere between 2% and 30%. Again, type of car, where you are, who you are can make a lot of difference. A home equity loan is when you take a loan out on the dollars that you've put into your home mortgage. So if you've been paying it on it for a while and you've paid down some principal, or the value of your home has gone up, then there's equity in it and you can borrow against that. And that interest rate is usually just a little bit more than a mortgage. So we might say right now somewhere around 4 to 8%. Again, okay. Now we get into some of the more interesting loans. A payday loan. I'm not sure if anybody's heard of a payday loan before, but this is a type of loan where you can get it for a couple of weeks, and then when your paycheck comes, then it's due and you pay it. So it's a short-term loan typically, but and this is a good example of where it doesn't always seem like a lot of cost to take out a payday loan, but if you look at it from an annual perspective, the costs are more apparent. So I'm seeing some on-target comments in the chat about this. Now in Illinois, we have a limit on traditional 2-week payday loans. They cannot be over 99%. In different states this is a state law, so if you're from another state today, it could be different in your community. And that's not to say they're, pardon? Yeah.
I was just gonna say jumped in, like I've seen as high as like 300+% in some states, so it can get really high.
Right. That's why we have a state law now. Yeah, and it doesn't have to be that high, but it could be that high. Student loans, I think the student loan range is quite a lot too. So it could be as low as 3.8%. I think that's the lowest we've got going right now, but it could easily go over 15%, especially if somebody is going to a financial institution and taking it out as a personal loan, then it kind of bumps up and people still talk about those as student loans. The last one, so yes, the difference often, Maryland, is whether it's federal or private, that sets a lot of the range. Last one I wanted to talk about is a vehicle title loan. And a vehicle title loan is where the vehicle is the collateral. So if I own a car, I could go to somebody and say, here's the title to my car. I'm going to use my car as sort of the hold against it, and then they would loan me money. Again, this is something that we didn't see as much in Illinois until the law came into effect that held down the interest rates on the payday loans. And what we see is that vehicle title loans, again, can vary a lot. Does anybody want to guess how much they can vary in the chat or what they are? Kind of. So our money mentor knows. Thank you, Jim. 350% is one of the average federally. We've also seen this state, there's a report that shows around 235%, so that's the one I put in here. There definitely can be up at 350%, and that gets very expensive. And what we know also from research is that 1 out of 5 people who take out a title loan loses their vehicle because they can't make the loan payments. This is just a very high amount to try to pay back, because typically people take them out when they're in a real emergency situation. They may be making decisions under a lot of stress, a lot of emotion, and the situation that drives them to take out this kind of a loan means that they probably can't afford to pay it back, or it can be very hard. So, all right. So when we're talking about debt and credit like we are today, we need to keep in mind that APRs have a lot of variability. All different products are not created the same. And that needs to be factored in when they're making decisions about whether or not to use debt. All right, I'm going to turn it back over to you, Seisha.
Thank you, Kathy. I appreciate it. So next up, we're going to do a little activity. So if you saw on our intro slide, as you were coming in, that you might need a pen and paper, this would be the kind of the time when you might want to grab that or like, jot some of this down in a minute. But we're going to be talking about Sam. And Sam has been living paycheck to paycheck for most of his life. Unfortunately, recently his wife died and he was left with 3 sons, ages 3, 5, and 8 in their family home. Sam now realizes that his wife's paycheck paid for the children's clothes, weekly groceries, and daycare. Without her paycheck, it's really hard for him to pay the bills. Sam just noticed that he needs 4 new tires because of the tread's really bad. It's just they're old tires. He needs new ones. He's kind of neglected them. And he needs this car to get to work and for the children's babysitter. And he doesn't have money to save for the tires right now. He kind of thinks he might get a tax refund. So, that he might get that when the time comes for his income tax return. But now he really needs to borrow the money. His bank has turned him down for a personal loan. And a loan officer said that he had already too much debt. I'm sorry. So if you don't mind, if you got that pen and paper out, if you want to write down 2 or 3 of these, so there's a couple options. And then what we're going to do next is we're actually going to send you to a breakout room. And you should be able to unmute yourself when you get to the room. And I'm going to ask you a question once you guys get there. And if somebody in your room could just take the lead on talking about these, the pros and the cons. So just take a few seconds, write one down. I'll also put them in the chat once you guys get to your breakout rooms. How did it go, everybody? If you want to answer in the chat, I know we kind of muted everybody again, but if you wouldn't mind, did you guys make a decision on maybe one of them that he might want to pick? Good discussion.
What was the one that your group thought was the best option? The tax refund anticipation loan, and we kind of forgot to explain that one.
Yeah, we did.
Because it wasn't in my list. A refund anticipation loan is where you go in and you pay your taxes with somebody, and then that means that they can see how much you're going to get back, and they'll give you a loan so you get it back that day instead of waiting for the electronic deposit. Pawn jewelry, depending on sentimental value, tax refund.
Someone that said getting rid of the least favorite child. Just kind of made me giggle, so thank you for that.
Yes.
Did anyone ever had any other ideas on what Sam could do? Just want to ask that before we move on.
So I should mention, and somebody's kind of commenting on that, there are definitely costs and fees to the tax refund loans, but one of the benefits that I think comes up sometimes is that you don't have to pay it back. You pay that fee out of it, and then you're kind of done, and it's your money that you are going to be getting. But there are definitely other options, so people are putting those in too, like social service grants, seeing if there's any life insurance policies around.
It says borrow from friends or family.
Through their church. This is fantastic. You guys just rock this.
Yeah, it's good. God. Great.
And you do have to be in the tax season to get a tax refund loan.
Well, technically we are still in the tax season this year. Doesn't end until July 15th. So just remember. So I'm going to move on, and we're going to talk a little bit about, I just want to quickly mention this. This is kind of a sneak peek for our June 25th webinar. We're going to be talking about repaying debt. And so I just wanted to quickly just throw out there in case you're not able to make it with us. But I love PowerPay. PowerPay is a really great website that's free and available. It's from Utah State University Extension, and they have this website that you can go in and put all your debts in, and then you can figure out, what's the best way to pay it back. So we'll talk more about that on June 25th, but I just wanted to give you just a little taste about PowerPay. So next up, we really wanted to talk about debt to income ratio, mostly because I think it's a good ratio to know about. So debt to income ratio is kind of what it sounds like. It's calculated your debt to income ratio. So on one side, you have all your monthly debt. So things like your mortgage, car loan, maybe your student loan payment, and then that's divided by your gross monthly income. So in this example, this debt to loan income is $2,000 over $6,000. And let me just do the math really quick if my phone will work. Gosh. Just one of those days, guys. And I should have had this in the chat already, but just one of those. And so his debt to income ratio is 33%. So sorry, should have known that. My brain was, oh, it's one of those. Just need more caffeine today. But it is important to know about when we're talking about taking on more debt or not. Another thing that you should be aware about is if you are someone who has debts that are deducted already from your paycheck, such as wage garnishments or anything other like that, be careful not to put these debts that are not counted twice in your debt to income ratio. So, and again, in that example, if $1,000 or $500 of that $2,000 of that debt comes from out of your paycheck already, don't put that in. Just put $1,500 instead of $2,000. So, great things to talk about. And I also want to mention that the debt to income ratio, that it's more like a guideline than actual rules. I kind of think you to think of a famous pirate movie that they talk about guidelines. But basically, we want you to know that there is evidence from mortgage loans that suggests that people with a higher debt to income ratio are more likely to run into making monthly money trouble problems. So this is just something to be considerate of. Again, like I said, this isn't a hard and fast rule, and it really depends on where you live and what your household makeup looks like. But we'll talk about that more in a second. So just want to kind of look at the slide and just kind of describe it. A lot of lenders really like it if you're below 20%. It's okay if you're between 20 to 40% of that debt to income ratio. And then if you're above 40%, that's when people kind of start to look at it and kind of be more cautious. Again, that's not every lender, and it really depends on what state you live in. So I really just wanted to talk about dinks and dukes. So a dink is a couple who is a dual income, no kids. And a duke is dually employed with kids. So it's kind of the difference in between the families. So let's again say you have a debt load, maybe it's close to 40%. For a dink, dual income, no kids, this might be okay. They might be able to have a house and all their debts, and it gets up to 40%, but that 60% that's left over, they're able to pay all their other bills, pay for food, pay for those necessities, whatever those may be. But for a duke, 40% might actually be too much. We have to consider all the other expenses that they have. In this example, this family has 3 children. So we're looking at, possibly daycare. We're talking about food, clothing, gas. I mean, all those other things for 5 people when you have a larger debt to income ratio is really something to be considerate of. So we just wanted to talk about, looking at to assess the situation, and definitely account for living expenses because, every situation is different. And we just wanted to talk about that. And then lastly, when we're examining our debt load, we really want you to look at how does the debt to income ratio, when you look at it, how does it make you feel? If you're a young person who maybe just got out of college and just got done paying or started paying their student loans, your debt to income ratio is probably really high. I know that when I got out of grad school, my debt to income ratio on a monthly basis was crazy different than it is now that I don't have student loans anymore. So that's just kind of one example to be talking about. Of course, the other thing is we talk about if you have a higher standard of living. So if you live in a place like New York or San Francisco, Honolulu, Washington, D.C., Boston, Massachusetts, a lot of those places have a higher standard of living, and you might actually have to have a higher debt to income ratio than you would in other places. So it's just something to be considerate of. What are you comfortable with? How does it make you feel? Does it make you comfortable to know that's how much you have, that you're uncomfortable? Are you mad? Are you angry? Are you sad? Does it make you feel overwhelmed, or are you okay with it? Depending, again, like we talked about with the dinks and the dukes, your situation may look different from others and you may be comfortable with your debt load. So again, just something to be thinking about. So we just wanted to let you know, with all the things that we've been talking about, a lot of our resources are up on our consumer economics page at the University of Illinois Extension. So that it just popped in the chat. We're getting close to the end here, so I just want to let you know that as well. We also are really excited about our podcast. So you might have seen that go out last week if you were on the webinar, but that just went in the chat as well. And then we'll also talk about it later. But our podcast is something that we're really proud of. We've been doing it monthly, and we talk about all different types of financial feuds within your family. And then actually tomorrow, Kathy and I are recording another one, and we're looking forward to doing that. So I'm looking forward to it. We do ask for your feedback, so that's why we did this one now. So if you want to throw any, we hope that you can do the quiz just really quick. I think it's what, maybe less than 5 minutes, Kathy? Yes, she says yes. So we always love to hear your feedback, especially before you hop off the call, because we would like to hear, what you have to say. And then, of course, if you guys have any questions, we'll stay on for a little while. We're eventually going to move the mentors over to a different room. So if you're in the program for Money Mentors, Kathy's going to start chatting with you about a few things, and I'll stay in the room to answer questions and be here.
And I'm not sure how much we talked about Money Mentors at the very beginning, and people might be wondering about that. But we in Illinois Extension have a volunteer program called Money Mentors, and people go through training with us, and they're attending these webinars as part of their training, and then volunteer to help others work towards their financial goals. People ask for help from the mentor volunteers. And the training is just getting way in these 10 counties. In these 10 counties. If you're interested in becoming a money mentor and you live in one of these counties or work in one of these counties, it's not too late to get involved. So you could register and let us know about that and thank you, Emily, just put in the registration. And any age or stage of life can apply to be a money mentor if you're 18 or older. So, and we have people that ask for help between the ages of 17 and 80 plus. So we are serving all ages, and we love having mentor volunteers of all ages. Actually, that works well. And let's see, we've got some questions coming in, which is really great. So, how does saving for retirement play into debt to income decisions? I think I'll take one stab at this, and then I'll let Seisha talk about it too if she wants. But I think when I'm looking at debt to income, I'm interested in how much do I owe other people that are loans that are debt. That's not my monthly expenses like my food bill, for example, but things that I have a contract that I have to pay that debt back. But I also want to make sure that I have enough money to save for things that are important to me. So even if my debt to income ratio looks okay, but I don't feel like it gives me enough money to save for retirement, then I think my debt load's too high. So that's why Seisha was saying you have to take these different variables into account. She was using young families, but you also have to take into account where you are in your life stage. And if saving for retirement is part of it, that's an important piece. And Seisha, Peter and Florence are asking, is mortgage included in the debt ratio? There's different debt ratios that are used, but you want to jump in on that one?
Yeah, so I think it depends on your lender, but everything that I looked at online did include the monthly mortgage. So it just depends on if you'd like to include it or not. Some people don't include the mortgage if they do after tax income. So before after tax, don't worry about that. But it's just something that a lot of people do include that. So yes.
So yeah, in this case, we were using gross income, and in my opinion, mortgage would be included in that debt ratio. But that's the way we're looking at it from a financial education perspective. When you go to a financial institution or talk to some other lenders or things like that, they may have a different way of calculating it. There are different formulas out there. And I think we saw a question. I missed it.
Somebody was asking about many mentors in Whiteside County.
Yeah, there was another one.
someone was asking if a bank tells me that my debt wasn't diversified enough, can you explain how to fix that without going into debt too far?
I think I'm going to have to guess on this one, and Seisha, you can jump in too.
Mm-hmm.
I'm not sure that they were. I'm hoping they weren't telling you just to take more debt. What they may have been trying to say is that even though you don't have so much debt, when they're looking at people's capacity to pay, and they're looking at credit reports and credit scores, they don't really treat mortgage loan debt the same as they treat credit card debt. So $100,000 of credit card debt looks different than $100,000 of mortgage debt. And so that might have been a piece of it, but I am not knowing the whole situation. I'm having to hypothesize.
And I just want to jump in and just say that some lenders just like to see a variety of debt, and there could have been, there could have been no reason for it, or there could have been tons of reasons for it. I think it depends on what it looks like.
There's actually not as much science to lending as or rules that I guess that to lending as some people might think. Sometimes it's more about what that particular lender is looking for.
Mm-hmm.
So yeah, good questions.
But it's always good to shop around. So let me just throw that out there. It's definitely good to shop around. But we'll probably talk about that in a few weeks.
Any other questions? When taking student loans, can you estimate a debt-to-income ratio using expected job salaries to determine what is the maximum amount of debt you should take? I think that would be an interesting piece of information that you would be able to look at, yes, for it to kind of think about how much debt you should take, although I would advise taking what you need and not more. But I think that would be an interesting way to look at it, yes.
I agree.
I was trying to get an equity loan on a home I inherited. I only have 2 credit cards. My DIR debt rate was only 20%. Again, there's a lot of variables that go into whether or not somebody wants to loan you money, what the rate is, and different people can give different answers on a different day. Remember, a financial institution has to have money they want to loan that day. And then if they do have money to loan that day, they want to loan it to the person that they think is the most likely to pay it back to them. And that could just be who else walked in that door that day.
And there's other factors as well, such as your credit score and a couple other things. So great questions, everybody.
Any other debt questions? Well, I think I will stop the recording.
Mm-hmm.